Yeah, hello friends, welcome back to our channel. Today we are going to have a look at 10 short straddle option strategies adjustments. Okay, so this is in part one of the adjustments. So which here I covered only for the upside management. So if the stock tends to move on the upside, so how to do an adjustment. So I covered only on upside movements here. So we'll be making a part two video separately to do the adjustment if the stock tends to move on downside. Okay, so if you are watching our channel for the first time, then please do subscribe to our channel and also click on the bell icon so that you'll be getting the notifications whenever we upload any new videos. Also, I request you to watch all our previous videos which we have made for multiple option strategies, and also we have posted those adjustments as well. So okay, so previous video we have had a look at an short strangles adjustment. In that video we have had a look at how to convert our short strangle into a short straddle. So we have seen the adjustments till making that as a short straddle. Okay, so in this video we are going to look at how to do an adjustment for the short straddles. Okay, and also friends, I have posted our Twitter ID and the Telegram channels link in the description as well. So please do join our channel, Telegram channel, so that you will be getting any updates on the charts or any technical views. Will be posting in our both in Twitter and the Telegram channels as well. Okay, so that is a disclaimer, friends. So this is only for an educational purpose, so please do your own analysis before taking any real trade. Okay, so let's enter into one short straddle. So short straddle is an so those who have no idea about what is a short straddle, so here it is. So short straddle is an option strategy by selling the C and P at same time, and means like the same strike price and the same expiry date. Okay, so the preferable short straddle is like we should initiate using an at the money call option and the put options. Okay, so short straddle can be initiated if trader believe that the stock will not move significantly higher or lower in a certain period of time. So maximum profit of short straddle is the premium collected by selling call and put options, and the maximum loss will be unlimited if underlying stock move either above or below our break-even points. Okay, so below is an short strangles payoff graph. So I just took the same example which you have seen in the short straddle video. Okay, so we have sold 11,100 call option at 385 and 11,100 put option at 283, and the collected premium is like around 641. Okay, so this is our break-even points. So if the stock tends to move below this level, above this level, then our position will start getting losses. Okay, so hedging, so let's enter into an adjustments. So hedging short straddle while initiating our trade. Okay, so we can buy call and put at our break-even levels to hedge our positions if it goes wrong. Okay, so in this example we have a break-even of 10,459 on downside and 11,741 on the upside, as our total premium received is 641. So calculating with the premium received from the 11,100, so this is our break even on upside on the downsides. Okay, so we can buy 10,400 put option, so I'm making it as a round value. So buying 10,400 put option to hedge our downside risk, and buying 11,800 call option to limit our upside risk. Okay, so that our position will be hedged on both sides with limited loss. If underlying stock moves on one direction beyond our break even levels, then we'll be getting the limited loss. If we are not planning to do any adjustments, we can book our losses, which will be limited, as it's an we are hedging our position with buy on either on both the sides. Okay, so this is an iron fly option strategy. So initiating the short straddle and buying an option to hedge our position is a iron butterfly or iron fly option strategy. Okay, so adjustment 1, if market goes up. Okay, so our short straddle is at 11,100 with 641 premium received, right? So if market moves up by 300 points, which is half of our premium received, then create one more short straddle at 11,100. Okay, so we have collected the premium of 6,041. So half of this premium is like a rounding value was 300. So if Nifty is moving on the upside to 11,400, which is 300 points upside, then we are going to create one more short straddle at the level of 11,400. So we are so we'll be collecting extra premium in 11,400 short straddle as well. So by doing this, our short straddle will be averaged to 11,250, as we have one more short straddle at 11,100 and one at 11,400. So the midpoint of this is 11,250. So our short straddle will be average to 11,250. Okay, so by doing this, we'll be shifting our upper break even further like 150 points, at least 100 to 150 points if we have more time for expiry. Okay, so by doing this, we are shifting our upper break even. So initially our break even is like around 11,700, I guess, right? So 11,741. So by doing this, we can shift our break even to 11,800 something. Okay, so probability of getting profit will be higher as we have shifted our break even 100 more points. So even if the stock is keep on moving higher, and if it expires anywhere below our break-even point, then we'll be in the profit, right? So we need extra margin for this adjustment as we are creating one new short straddle. So we are not going to touch our 11,100 short straddle, and we are creating one new short straddle here. Okay, so should do this adjustment only if you are sure about the upside movement, because our downside break-even will be moving higher by doing this adjustment. Okay, so adjustment 2, market goes up. So roll up the put side by closing the existing position. So which means that we are having the short put of 11,100. So we are closing that 11,100 put option, and we are rolling up to the nearby strike price, which is nearby to the underlying stock. So for in this example, we are closing the 11,100 PE and sell the strike price, which is nearby to the underlying price. Okay, so by rolling up PE, we will get additional credit so that our break even will move up further level based on the premium we collected. Okay, so for example, 11,100 PE we are closing and selling 11,300 PE, since assuming that the Nifty have moved above 11,300. Okay, so in this adjustment, our max profit will be achieved if Nifty expire between 11,100 to 11,300, and still we are shifting our break even further 100 points, as we are that is based on the credit we received here. Okay, so in initial short straddle, we'll get the max profit if the Nifty expires at the level of 11,100, but in this case we'll be getting the max profit if it expires between 11,100 to 300, as we have sold 11,300 put option. Okay, so means like which we have rolled up. Adjustment 3, if market further moves up. So we have seen 2 adjustments to manage the upside movement. So even after doing that adjustment, if assume that Nifty is keep on moving upside, so now if market tends to move further upside, then we can create a put credit spread. Okay, so by selling one at the money PE and buying one out the money PE. So for example, sell 11,400 PE and buy 11,200 PE. So we are adding new position here and not touching our existing position or adjustments we have done earlier. So by doing this adjustment, our break even will move further upside. Okay, so hope you guys understood how we are initiating the bull put spread, right? So which is an credit spread here, right? So we are selling one at the money put option and buying one out the money put option to hedge this naked PE. So which by doing this, we are collecting some extra premium of like at least 70 to 100 points. So based on that, our break even will move 70 to 100 points on the upside. Okay, so adjustment 4, if market moves further upside. So even after making multiple adjustments, if market is too bullish, then instead of doing adjustments, using options, go long on future at break even level if market moves too higher. Okay, with this adjustment, no upside risk or very minor loss will be there, as we gone long on the future, right? So if market is keep on moving higher, and even if Nifty is going to breach your break even level and there is no much time left for the expiry, then it's better to go long on the future. So because like we don't have much time value in the option, so doing adjustment at using an option, if the expiry is nearby time, then it's hard to get the premium from any other option. So it's better to go long on future. So to hedge that futures to protect downside risk, if after going long and if there isn't some sudden downside movement, we're going to lose money from our future, right? So to mitigate that loss from the future, we need to protect the downside risk. So buy one put option at your lower strike price, which is like 11,100 in our example. So which is the whatever the strike price you are having at the downside, which is the lower strike price. So buy one put option at that level, as we have rolled up our put option on the higher price like 200 or 300, 11,200 or 300. So now we are not holding 11,100 put option, so you need to buy the 11,100, which will be available at the very lesser premium. Okay, so by doing this we can come out of the trade without having any upside risk. Only we'll be having having a downside risk. So we are going to have a look at the downside risk, how to hedge or do some adjustments on the downside. We'll be going to have a look at in a separate videos. So thanks for watching, friends. So please do subscribe to our channel, and also click on the bell icon. Also click on like, share, and do comment, so that we also feel happy that people are getting satisfied by looking at our video. So thanks for watching, friends.